Hi, everyone, and welcome to the Sustainalytics podcast. My name is Melissa Chase, and I'm a marketing specialist here at Sustainalytics. Today, we'll be talking about the most recent publication in our ESG Spotlight series entitled Hot Assets, Global Equities, and Physical Climate Risk. Today, I'm joined by two of the authors of the report, Doug Morrow, a director on Sustainalytics thematic research team, and Martin Vezer, a manager on our thematic research team. Welcome, Doug and Martin.
Hi, Melissa. Thanks.
Thank you.
So, Doug, let's get started by going into some of the motivating factors that led you guys to focus on physical climate risks.
Yeah, sure. I mean, I guess it was confluence of different drivers. I mean, obviously, climate change is kind of like the issue, one of the major issues of our time, and we wanted to take a look at it from sort of a unique perspective, from the physical climate risk perspective, which is something that Martin and I had not done before on the thematic research team. So yeah, I mean, investors often, as we all know, think about climate risk in terms of these two big buckets. So transition risk, which looks at the effect of climate policies as the economy moves towards the low carbon transition. But there's this whole other bucket, as I said before, of physical risk. So we had looked before at transition risk. So we really wanted to emphasize and focus on physical risk in this paper.
I see. So, transition risks and physical risks are the two interconnected issues, but for analytical reasons, you treat them separately. And in this report, you took on physical risks because these risks are becoming more of a concern as global emissions and temperatures escalate. So, Martin, can you tell us about how you assessed physical climate risks in global equities?
Sure. We took a look at this from several perspectives, but generally we like to think of two broad dimensions of risk analysis. One is the exposure side and the other is the risk management side. So we look at physical climate risk both from an exposure perspective and from a management perspective. And on the exposure side, we look at the geographically segmented property, plant, and equipment disclosures of companies in the global equities market. So property, plant, and equipment, or PP&E for short, is one of the most exposed asset categories to physical climate impacts. So we did an analysis of the approximately 3,000 companies listed on the FTSE All World Index and found that relatively few companies disclose geo-segmented PP&E data. So this is PP&E is a standard input in financial statements, but companies don't have to segment the value of their PP&E by geography. And we just wanted to see how many companies actually do this. And we found only about 16% of those 3,000 companies appear to report geo-segmented PP&E. And even those companies that do segment their PP&E by geography do so at quite a granular level. Usually they're referring to markets where they have PP&E or broad catch-all categories such as foreign or overseas locations. So to fill in these gaps, we've seen a lot of specialty research providers finding innovative ways to assess exposure. They sometimes draw on satellite images, climate simulations, and commercial mortgage-backed securities. And we think this type of research is only going to continue to expand. It's really taken off recently, but we're expecting to see much more of it in the near future.
Okay. So PP&E is an asset class that's exposed to physical risks, but the way that companies report their PP&E isn't really amenable to assessing local exposure to physical climate risks. So you said if exposure is one side of the issue, then management is the other. So Doug, can you tell us about how you address the question of how companies are managing their physical climate risk?
Sure. So essentially what we did here is we have an indicator in our toolkit that looks specifically at physical climate risk management programs. So this basically measures the extent to which management teams are aware of the physical impacts of climate change, including rising sea levels, the increasing frequency of extreme weather events and things like that, and the extent to which they embed these types of considerations into project planning, climate proofing their assets and things like that, which admittedly is often a very, very difficult thing to do. But nevertheless, we felt that this indicator would give us broad insight into some of the differences in how management teams are approaching the issue. So what we did then is just look at a cross-section of different sub-industries for which this indicator is activated. As you can see, for those of you who have already read the paper, we focus specifically on a basket of 5 sub-industries. These are cable and satellite, telecommunication services, real estate development, REITs, and then travel, lodging, and amusement. And then we took a look at, as I said before, differences in how management teams within these sub-industries perform on this indicator. And essentially, to sort of move past the minutiae, I can give you the high-level takeaway, which is basically that of all the firms we looked at, in about 200 in total, only about 20% were rated as having a strong physical climate risk management program.
Wow, so that means that 80% of the sample had substantial room for improvement. So can you tell us about how the different sub-industries you considered compare?
Sure. So, I guess at the high end, what we found in our study was the telecom services sub-industry. So this is capturing all the big telecom players, tended to be the best positioned. So about 20% of companies in that industry demonstrated what we consider to be a strong physical climate risk management program. But even here in this sub-industry, just under half of all companies disclosed no program. So in other words, even though they were tended to be the best performers, objectively speaking, the bar wasn't fantastically high. On the other end of the spectrum, what we found is that companies in the real estate development sub-industry really tended to trail on this measure. So over 80% of the companies in this sub-industry disclosed no program. Now, again, part of this is disclosure practices. So some industries tend to be more opaque than others. But based on what we're seeing, the vast majority of companies in this sub-industry do not disclose the existence of any type of physical climate risk awareness.
It's really interesting to see so much variation between the different sub-industries. So, Martin, you guys also looked at water stress related risk. Talk to us a little bit about that.
Yeah, water stress is a really important issue when it comes to climate change. So we wanted to take a focus on this particular type of physical risk. Climate model projections indicate that many renewable water sources will be reduced in sensitive regions over the century. And so we wanted to apply one of our other indicators that looks at water stress and water risk management. And here we look at 5 other sub-industries. So we've got agriculture, electric utilities, multi-utilities, integrated oil and gas exploration and production in that sample. And we look at how water supplies are really important for all of these industries, and water stress can affect the efficiency with which companies in these sub-industries can bring important commodities to market. Our sample includes 145 firms that are in these sub-industries and also listed on that same index that we used throughout the study. And looking at this subsample of companies, we've again found that the market appears to be underprepared for physical climate risks. Only about 25% of these firms disclose strong water risk management programs. But again, we find quite a bit of variation among the approaches that companies in the different sub-industries take to address the issue. For example, just under 40% of the firms in integrated oil and gas disclose strong programs compared to just 4% of oil and gas exploration and production companies. So it's interesting to see how companies within the same sector but in different sub-industries take on these challenges in different ways. We also compared multi-utilities and electric utilities. 37% of multi-utilities have strong water risk management programs, and only 26% of firms in the electric utilities have strong programs. Agriculture also appears to be underprepared, with about a quarter of the sub-industry rated as having a strong program, and the remaining 75% has either a weak program or no water risk management program at all.
Right. So it really sounds like the market appears to be lagging in this respect. So what can companies do to address these management gaps?
Well, it starts with companies acknowledging that these risks exist, setting targets, developing initiatives to measure their exposure, and build management programs to mitigate potential impacts on their operations and supply chains. And while only a minority of companies in our sample have strong programs in place, the companies that do show that it is possible, and we anticipate other firms gradually following suit. Just as a quick example, we found one REIT in our sample that has published a best practices document detailing flood risk management plans for properties that could be hit by storms. With climate change, this is one of the big concerns for a lot of real estate companies. And this particular company has worked on strengthening its infrastructure and addressing water retention issues, drainage systems, and looking at ways of really insulating properties from some of the concerns around extreme weather events.
Great. Thank you so much, Martin and Doug, for sharing the insights from the report. And thank you to everyone for listening in today. Again, our most recent ESG Spotlight series report is called Hot Assets, Global Equities, and Physical Climate Risks. And it's available to download from our Knowledge Center at www.sustainalytics.com. Thank you again, Martin and Doug.
Thank you.
Thanks, guys.